Hey guys, welcome back to another video. In this video, I'll be going over stop loss hunts, what they are and how to avoid them. But first, make sure you subscribe and help me reach my subscriber goal of 1,000 subs and hit that like button to help YouTube recommend my video to other people as well. So now that we've covered all of that, let's get into it. So on my screen, you can see I have two examples drawn out for you. Now, what these examples go over is the fact that stop hunts generally happen when people take trades where we have equals. So as we can see, we have an equals here and we have an equals over here. Now, if I just focus on this example for the time being, price creates an equals and then pulls away. So at this point, many traders, many smart money concept traders will be looking to take a buy from this area here. So if I draw that out, they'll be looking at this order block here. Now, the reason why this is not a wise thing to do is because we shouldn't take trades when we have liquidity below an order block or liquidity above an order block. So for example, if we have our, let's say, order block over here, we should never take a trade, or generally not take trades, when we have liquidity above or below an order block. Now, this is because when price reaches this order block, it doesn't have much to move in order to grab liquidity and continue in your direction. And we can see the same here. Now, on this diagram, I've also drawn this area here. So this is here to represent a demand zone and here to represent a supply zone. So generally what will happen is we will have an order block or a zone of interest below the equals that price will come, grab the liquidity from this equals and then tap into this area and then move away. So that is why most people get stop hunted, or if we correct that term, to a liquidity grab. Price is only coming to grab this liquidity. Those that take trades here have gotten in trades that are less likely to succeed, but those that get into trades here are more likely to succeed because the storyline is written that price is going to come, take this liquidity, tap into your order block and then continue to the upside. Now, obviously the same is true with this example. Price is going to take this liquidity here, pull up into the supply zone, and then we can expect a sell-off like this. So taking trades from this location over here and this location over here is not wise, and instead we should be looking to avoid taking trades in these areas and expect that if we have a buildup of equals liquidity, as we have in these two examples, we should look to take trades from order blocks below this liquidity or above this liquidity. Okay, so now that we've gone over two examples, the bearish case and the bullish case, let's go over a live trade example where we look at this in action on the charts. This trade example, so I found a very recent trade example where we can use what knowledge we've just learned and apply it to the charts. So from here, we can see that price is moving to the upside. So we have really nice order flow and we have breaks of structure as well. So as we can see, we are breaking that major structure and around here, and we have breaks of smaller structure as well, for example like this. So we can see we are moving to the upside and the order flow is telling us we should be moving to the upside. Okay, so at this point what we're looking for is, so we want to take trades generally from, let's say, this order block here, and we want to ensure that our stops are below here when we take the trade. But from what we've learned, this is incorrect, and what we should be doing is we should be looking at trades from this order block over here. You could possibly say that this is liquidity over here, but what I want to bring your attention to is this order block here has been mitigated twice, so it is not in consideration for taking buys from, since it's been mitigated already twice by this candle here and this, these candles over here as well. So as price comes, so I'll skip down, we can see price takes this liquidity, and actually I should mark out the liquidity here. So there's our equals liquidity, and it's taken out this liquidity just as we'd expect it to. We would have entered a trade at this point. Let's say price triggered us in. We'd have our stops. What's that? 9.5. Let's make it about 10. And we'll have our targets you know, wherever, let's just say to this high, for example. And then price comes in, we get our secondary touch as well. Given that this looks like there was some sort of news candle and event, and it's respected this demand zone, which is a good sign. Now we're getting some, you know, good candle closures. This candle closure is a very good candle closure in our direction, and as we can see, you know, price comes in, another touch, and we've exploded to the upside now. This was a very easy trade to spot. We have our liquidity, we have our demand zone, and we've taken advantage of what we just learned, and we were able to take a successful trade. And for example, this one would have given you a very nice 1 to 5 nice and easily. Obviously, the opposite is true as well. So as we can see, I've just inverted the same example the other way around. So this is something that you'll look for, and this again, very textbook type of trade, which gives us a nice 1 to 5 risk to reward. So again, thank you for watching. Make sure to like and subscribe. Follow me on Instagram, as I'm going to become a lot more active on there as well. And I will see you in the next video.